This crash and 9010 crash protection video was originally produced in October of 2016, just prior to the election of Donald Trump. His surprise election extended the timetable for a potential stock market crash. However, the rationale for a potential crash which was explained in the 2016 video has remained intact. Dynasty Wealth is currently producing an updated version of the 2016 video. Due to the extreme volatility of the markets, we thought it would be best to provide you with access to the 2016 video. To be alerted when the new video is available and to also receive updates on our ongoing crash research, sign up for the free Dynasty Wealth newsletter.
This presentation is about the impending market crash and a 90-10 crash protection strategy. This video is available to you from Dynasty Wealth Investing. Michael Markowski, with 40 years of experience, conducted the research that is contained in this video. He was named by Fortune magazine as one of its 50 greatest investors. Michael predicted the collapse of Lehman Brothers, Bear Stearns, and Merrill Lynch in his Equities magazine column 1 year before Lehman went bankrupt. Michael specializes in global market anomalies, small public companies, and digital companies that have the potential for 100 times return on investment. Here are the highlights from Michael Markowski's September 2007 Equities column. He stated that a day of reckoning was coming for the 5 largest brokers, and that it would be sooner rather than later, and it would be ugly. This chart depicts the 2 most recent crashes, the 2000 dot-com crash and the 2008 Lehman crash. The peak-to-trough declines for the 2 crashes ranged from 46% to 48%. The dividend yield of 1.5% at the peak of the dot-com bubble ranks as the lowest for any peak dating back to 1870. The yield of 2.1% prior to Lehman's bankruptcy used to rank as the second lowest in the last 150 years. However, today's dividend yield of 2% now takes over second place. Gold does not protect against crashes. During the dot-com and Lehman crashes, gold declined by 12% and 17% respectively. Broad diversification does not protect against crashes, recessions, and depressions. Whenever a market crashes by 40 to 50%, all stocks decline, and portfolios, mutual funds, and retirement plans that have stocks in them decline together and significantly. The priority of the 9-10 crash protection strategy is return of capital instead of return on capital. Under a 90-10 crash protection strategy, 90% of all liquid assets are invested into notes of a country that has a credit rating of AA+ or higher. To reduce market risk, the notes should have maturities of 5 years or less. The U.S. is one of 17 countries with the highest credit ratings. There are only 17 of the world's 200 countries that are worthy of investment. These countries have a track record for being able to collect taxes from their citizens to pay off their debts during tough economic times. This bar chart of the top tax brackets under all U.S. presidents, from Woodrow Wilson to Obama, is a good example. After the crash of 1929, the highest tax rate went from 26% in 1929 to 80% in 1936, and ranged from 80% to 93% until 1964. Given the situation, it is very likely that U.S. taxes are going to increase significantly with the economic downturn. Under the 90-10 crash protection strategy, the remaining 10% of the liquid assets are to be invested into a diversified portfolio that has the potential to increase by 300% in 5 years or less. The portfolio would include some or all of the following: venture capital, small public companies, and stocks under $10. Since crashes coincide with economic contractions and recessions, small companies have an inherent advantage over large companies. It is much easier for a dynamic small company with $5 million in revenue to double to $10 million during a difficult economy than it is for a large entrenched company with $500 million in revenue to double. From 1945 through 2007, small stocks, as depicted in dark green on the chart, consistently outperformed large stocks for the first 3 years after all recessions ended. Dynasty Wealth Investing is well positioned to capitalize from the recent crash of low-priced shares. It was founded by Michael Markowski to identify opportunities having the potential to multiply by 10 to 100 times within 5 years. The opportunities that have 10 to 100 times potential include small public companies that have scalable intellectual property, private companies in the emerging digital industries including crowdfunding, smartphone applications, Internet of Things, and digital first movers and disruptors are also recommended. Facebook is a good example of the type of opportunities that Dynasty Wealth is searching for. Just $10,000 invested into Facebook's first $500,000 private offering in 2004 increased to $23 million at Facebook's first 2010 liquidity event and to $430 million at year-end 2014. Uber is another example of the type of opportunities that Dynasty Wealth is searching for. Just $10,000 into Uber's 2010 private offering was valued at $102 million in 2015. That equates to a multiple of 10,000 times investment within 5 years. $1 million invested into the 90-10 crash protection strategy could potentially grow to $2,050,000 in 5 years. The $900,000 invested into the notes would appreciate to $950,000, and the $100,000 invested in the Dynasty Wealth recommendations could potentially grow to $1,100,000. By allocating 90% of the assets into no-risk notes and 10% into growth, the return could potentially be 21% annually while risking only $50,000. Financial advisors will not recommend crash protection strategies since they are at conflict. They will lose 90% of their management fees when you buy government bonds. And because of the new Graham-Dodd regulations, they can no longer advise you on the remaining 10% targeted for high growth.
For free crash updates, sign up at dynastywealth.com.